Hey guys, so it's been 12 months now since the start of the COVID-19 outbreak, and we have been speaking with some investors the last couple of months that have just re-entered the property market after 12 months out, and we've been having some interesting conversations with investors, and it's mainly been centred around the changes that COVID-19 has brought to the property market, and we are frequently asked, what trends have we noticed in the last 12 months, and our investors that stayed in the market, how are they now buying versus, what they were buying or how they were buying prior to COVID-19. So one of the main changes that has affected the property market has been this new revolution of working from home. So it's interesting, this theory now that we're working from home, or are we actually living in our offices? And that's very much affecting the UK property market because tenants now want separate spaces in their houses or their apartments that separates the office from home. So we're noticing a tenant demand now for larger properties, so for 2-bed apartments or 1-bed apartments plus study, or those apartments that do have some kind of outdoor space, whether that's a balcony, a terrace, even a Juliet balcony where you can just open up the patio doors and have some fresh air. So we're now noticing a demand for bigger spaces, and not just bigger spaces, we're noticing more of a demand now for amenities, on-site facilities, on-site landscape gardens, shops close by, gym facilities, concierge facilities, all of those amenities that make life easier whilst we're working from home, and sort of the urbanisation of residential spaces that means that tenants don't necessarily have to leave their home in order to have a convenient quality of life. So that's the main difference, is this working from home culture that's come around that has now meant tenants spend a lot more time at home than they ordinarily would. Now, in light of that, there's also been this huge increase in tenants moving to commuter towns rather than living in the city centre. Now, we were discussing this this morning at TD, and we feel a little bit smug because we have been talking about commuter towns for the last couple of years. We've been speaking to our investors about the benefits of commuter towns rather than city centre. You get a lot more for your money. There's just as much tenant demand. Rental yields tend to be higher because the property prices are lower, and the rentals aren't that much lower in value. And not just that, you also get the benefit usually of two major cities, because usually you're in between both. And let's not forget, transport links in the UK are absolutely exceptional. So we've noticed in the last 12 months, because people are now working from home or they're being given flexi hours, and there's a lot more of an acceptable culture about working from your home rather than going into the office, we've noticed tenants now are wanting to save a little bit of money on their rent, and they're happy to move to commuter towns. Now, not only is this more flexible for them in terms of their rental payments, that they usually don't have to pay as much, it's also more convenient for them because they don't have to live in the city in order to be close to work, because they are going maybe to the office twice or 3 times a week. They would rather save a little bit, maybe £100-200 a month, living outside the hustle and bustle and commuting in once or twice a week as and when it's required. So, these commuter towns, just for example, if you think of Birmingham, you've got places like Wolverhampton and Redditch, which surround Birmingham, 15-20 minute drive, half the rental price for tenants, double the rental yield for investors, by the way. You're looking about 8% rental yield in those areas as opposed to 4% in Birmingham city centre. So it's win-win. It's win for the tenant and it's win for the investor. And then places like Manchester, you've got Bolton, which is in Greater Manchester, places in Liverpool, you've got the Wirral, you've got Cheshire, these places where people might not necessarily work, but they're willing to live in order to commute to the bigger cities. So that's another observation that we've made. And one of the key observations, which I think is not just what we've noticed, it's what our big investors have noticed. Our investors that have been doing this for 10, 15 years, they've gone through multiple recessions, they've gone through COVID-19, they understand the market very often more than we do ourselves. And we've just noticed the resilience. resilience of the UK property market. And I know that's my favourite word. I feel like I use this word in all of my videos, but it's true. The UK property market is incredibly resilient. Now, during 2020, the UK property market, the property prices increased about 7.8%. Now, that is taken into account that the economy contracted by 10%. So that is absolutely phenomenal. They aren't my figures. That's the analysis from Savills themselves. So go and check out the numbers. It really is absolutely exceptional what the UK property market has done throughout what has been a really trying time. COVID-19 was the biggest stress test on the UK property market. And I think it just goes to show that COVID-19 is no match for the resilience of the UK buy-to-let market. And these are our three key observations, what we've noticed, what's been happening in the last 12 months, and what our clients have been looking at, and the way they've been adapting their property investments in order to continue diversifying their portfolio throughout the times to come.